Hello everyone, how's it going? In this video, we're going to look into this company called Teladoc Health. We'll go over both the positives, which is the bull case scenario, as well as the negatives, which is the bear case scenario. This stock has seen a huge run up ever since it started. Back in 2015, it came public, and since then, it has been growing crazy. So let's try to understand what's the company about and what are some of the negative aspects as well. Number one, the huge tailwind that they have going on for themselves is they have good balance sheet and they're continuously buying and acquiring new companies. So this is back from 2015 in their first annual report. They explain about how they've been buying Stat Health Services, which was Teladoc, BetterHelp, EmeryDoc. Then in the later annual report for 2020, they spoke about Livongo, InTouch, Advanced Medical. In total, they have about 12 or more acquisitions which Teladoc has been purchasing over the past few years. This brings the company a huge, deep moat that they are continuously widening for themselves. And with this, it will create a barrier to entry, especially with regards to the amount of acquisitions they're doing and the type of services that they're providing. And each of these companies, before acquiring, have purchased and done their own acquisitions prior to joining Teladoc. So they are coming full circle with regards to the services that they're trying to provide in the healthcare services. And that will create over time a compounding effect, especially with regards to amount of members that they're collecting and physicians also joining in. And that compounding effect will attract more physicians and more members eventually, and that will keep on compounding for them. So that's a huge tailwind that's going on for themselves. And only time will realize what this will come up to be in the next 5-10 years. Now, the next is their majority, they sell their services to clients, which are employers. So, and that is where the workers' compensation comes into big play. Especially if someone is this is something which is very prominent in the gig economy, where if someone gets hurt at off office hours, so anytime after 5 o'clock, when the outpatient services are closed, it's difficult for workers to find good outpatient facilities which are open after 5 o'clock. And that's where they end up going to emergency off. And in emergency, the rates are anywhere from 4 to 5 times the amount of billing that you'll get from outpatient services. And that's where a service like Teladoc comes in, where you can find a physician 24/7 and get their help right on spot without going to an emergency facility. That's where employers are starting to adopt this. And this is a good market, especially in the workers' compensation. Now, this is something which I've been talking about in most of my previous videos or analysis. This is about 100 back, and this was a report that came out from Tony Analysis. And just to quickly understand, in this chapter, in this report, he went over a couple of companies that has given 100 baggers over the past few years. And he found few underlying patterns in all these companies. And this is the most interesting pattern of all. He's assuming two companies. Let's say there's a company called Flat and there's a company called ACC. And he's explaining what among the two companies which will have more growth as a shareholder. Now, let's assume that the earnings per share is 2000 in the year 2000 was $4. So $1 for each quarter. And in the end, you had $4 earnings per share for both the companies. Then the subsequent year, which is 2001, let's say the earnings for Flat was 1.25 for quarter one, 1.25 for quarter two, same for quarter three, and same for quarter four. So in total, if you add all the 1.25s, you'll get about $5 per share, earnings per share for 2001. But in ACC, they went a little bit different. They had incremental growth over the quarters. So in 2001, quarter one had about 1.10, 1.20 for quarter two, 1.30 for quarter three, and then 1.40. So they have been seeing 10% growth every quarter. And at the end, if you add, you'd still get the $5 per earnings per share for both of these companies. But since ACC was growing incrementally over the quarters, it will enjoy a better share price over the next year. And that is something which you can see with Teladoc's growing revenue. They're not profitable, but the revenue is growing. And if you can notice the quarterly, you can see the revenues are growing. Annually, the revenues are growing. Last year, yes, they had a very huge run just because of the COVID. And COVID basically catalyzed or pushed that growth further. They were growing before that as well, but with COVID, they expanded even more. Now, this is the most interesting aspect about the business, and which is probably being overlooked: the value of time that the business is creating. This is something which Gary Vaynerchuk explained. He had missed the Uber investments in the first few rounds, and he later realized that the biggest value that Uber was creating, it was not the ride sharing facility, but it was the value of time that they were providing. For someone to wait for a taxi to come for you, instead of that, now you could control these taxis and these ride sharing facilities for you to go on to different places. And that is where Teladoc is coming as well, where instead of going in, setting up an appointment based on the availability of the physician, waiting, having that time taken out from your other days of activities during the day, leaving work, taking time off in order to go to a physician, that is complete waste of time and very inefficient way of doing things. Instead of that, imagine if you're going back home, on your way back home, you just wanted to have a quick consultation. On your drive back home, you can call the doctor, set up an appointment right there and then have that thing immediately taken care. Of course, these are for smaller cases. In the bigger cases, you might have to just directly go to the doctor. But still, majority of the cases where you're not going to the doctor, you just need a quick consultation, you can do that right there and then, hence creating a value for time. And time is the most valuable resource at this particular age. Well, the thing is, every generation that you come across, people in the subsequent generations, they tend to do more and they require more time. And hence, providing these services will definitely attract people in that sector. Now, let's talk about some of the negatives or the tailwinds that this company has going on for themselves. If you just pay attention to this, the amount of shares that are held by insiders is only 5%, and there are a couple of insiders in there. It's not a founder-owned company, it's not a founder-led company. The founder has retired, and it's an agent who's running it. And the problem with agents is agents are more concerned about their own career, their own well-being, their own reputation in the market rather than the company. Whereas a founder-based CEO has more concern about the company than himself. The only thing he worries about is the company, and the company is like a baby for the founder. But in this case, Jason, who's running the company, he's not the owner, he's just the agent who's running it. So that's one thing. Now, the shares held by insiders is only 5.63%. So the skin in the game is not so much. And Charlie Munger mentioned about this. Show me the incentive and I will show you the outcome. And if you look into that, we have a history of cumulative losses. This is something which they explain in their 2015 annual report. We have a history of cumulative losses which expect to continue, and we may never achieve or sustain profitability, which is fine. If you're growing, if you're trying to increase your revenue over the period of time, Amazon has done that. Yeah, okay, it makes sense. But this is where the problem comes in. We will continue to have an adverse effect on our stockholders' equity and working capital. Raising additional capital through debt or equity financing in order to fund our operation. So there will be quite a bit of dilutions that will go across. And here, when you have insiders who are not so much involved in the share price of the company, they don't have any incentive on maintaining the price of the share. And hence dilution is nothing but a way for them to just generate money. So they're not going to be bothered about the price of the share. And if you look into the data Roma for the past few, let me quickly look it up for you, data Roma. And if you go into Teladoc, we will see the amount of insider shares that are going on recently. So if you go to Teladoc and if you see the insider activity, you can see in the past few months or even past few years, everyone within the company have been selling out shares. And selling is not so much of a concern. Monish Pobrai mentioned that selling happens. People sell for a variety of reasons. So selling is nothing too much of concern. But if someone buys, then they buy only because they consider that the price of the share is way less. And you don't see any insiders buying at the moment. So they know that the price of the share is way higher than they were expecting. Now coming down here, this is something which they have some issues going on, because especially with the healthcare industry, it is very much regulated, especially in the United States. Now, this is something which in the 2015 annual report, they explained how in 2014, they had to even suspend operations in the state of Arkansas and Idaho because they changed some treaties, some affiliations, or some laws regarding telehealth. And because of that, they had to suspend their business operations in the state of Arkansas and Idaho. So these are some of the headwinds, just because of the type of regulation that's involved in the healthcare industry. This is another one back in Texas. And Teladoc even filed a case against the Texas Medical Board because of some of the laws that they had changed. And they're explaining that Texas accounts for a majority of their revenue, which is 16% or even 23% or even 12% in the past few years. And I don't know what the ratio is right now, but you can see that the amount of effect that the state laws and regulations can have on them. Next is the liability claims. And this is a big, huge problem, not just for Teladoc, a medical industry in general. Any issues taken care or any problems going on with the physicians or anything to deal with the medical care that was provided can cause huge liability claims. And Teladoc, there are two entities. So Teladoc's telehealth services, which is the software end, and then there is the Teladoc Physicians Health. And that Physicians is it's not affiliated with Teladoc, but it's part where it controls all these physicians they are part of the network. And anyone who gets these liability claims will affect the overall company. Next, you have the capital allocation issue. They're talking about this. It can divert our management's attention, result in dilution to our stockholders just because of all these acquisitions that they are doing. In addition, we have limited experience in acquiring other businesses. Still, the company is going about, and we saw how they've been acquiring businesses over the past few years. Well, that's a good thing. But if the capital allocation is not done in the right way, then you're now creating problems for yourselves instead of creating value. Now, just look into the example of this. Livongo Health was purchased back in October of 2020. And if you recall, since March of 2020, the share market has been in a euphoric stage where all the shares are going up. It's a huge bull market that's been going on since the start of March 2020. And Teladoc decided to purchase Livongo Health, which was a recent IPO. And they bought it. It came out with 3.4 billion, and Teladoc within a year, it acquired at about $18.5 billion. And this is where the problem of insiders come in, where the insiders are not so much concerned about the share or the money or where the money is coming through. They can go about purchasing and using the capital allocation the way they like, the way they feel fit. They're not so much bothered about the shareholder value. So you can see a company which was valued at 3.4 billion in a span of year, a little over a year ago, it was valued at 3.4 billion. And in just 1 year, Teladoc purchased it at about 18.5 billion. That's 5 to 6x. Now let's look at the competition for Teladoc. This is the biggest competitor. It's called Amwell or American Well. This is telemedicine. A few years ago, Teladoc was one of the pioneers, but as success comes in, capitalism is very brutal. Dog eats dog. When you see something is working out, you have other people jumping in, and that's what's happening here. You can see American Well. It's a public company now. These are competitors. The next guy is One Life Healthcare, and this is something which is interesting. They are also having that similar growth pattern which is going on, and they are also bringing revenue close to 380 million. Right now, for 2020, they had about $1 billion of revenue from Teladoc. But in 2019 and 2018, they had relatively less, about $500 million. So 3 years ago, where Teladoc was, right now, One Health is at that particular stage. So we don't know how fast this company could catch up with Teladoc. This, I feel, is the biggest threat for Teladoc, Amazon's own healthcare services team. And Amazon has been taking jabs on this for a few years now. This is not the first company they have started. They have taken many different steps in the past. And these are guys who can bleed to death any other company in the market. They have huge potential. They can purchase. They can do more acquisitions than Teladoc can even imagine. And this could, if they go into that direction, it might wipe out Teladoc very easily. Then you have MD Live, you have Doctors on Demand, you have Ground Rounds, you have Omada Healthcare, and you have Verta Healthcare. Now, these are a few companies that I found. I'm sure there are many other companies out there who are doing similar businesses similar to Teladoc. So it all depends on how the market goes through. So just found this interesting, wanted to share with you. With that, take care, stay safe, bye-bye.